Well, there's been a lot of talk about recession, and yesterday my team and I had a big discussion putting together as much of the data we could, and we had a really crazy thesis that we wanted to run by everyone because I'm always trying to look ahead at what's going on. I was one of the first YouTubers to actually sell when it was time to sell at the beginning of 2022. I was one of the first to call for the Nike swoosh recovery, which, knock on wood, so far is doing well. But wait a minute. The yield curve is so inverted. You've got office real estate collapsing. Credit Karma says 1 in 5 people aged 59 and older say they didn't have a retirement account, and 27% say they have nothing at all set aside for their later years. You've also seen baby boomers, 17% of them decreasing their contributions to their retirement accounts due to inflation. You've got 41% of Gen Z and 38% of millennials saying their net worth is zero or negative. Yes, that's literally what's happening to people. When you've got 4 out of 10 Gen Z or millennials sitting with a zero or negative net worth, people are robbing their retirements because of inflation. And we believe that a recession is afoot. In other words, a recession should be here if it's not here already, except what's actually happening? Well, what's actually happening is things are mostly still booming. In fact, we were supposed to have a bad earnings season, but according to Bank of America, of the 30 S&P companies that have already reported during this earnings season, 90% have beat on the bottom line. 73% have beat on sales. And despite the fact that banks are supposedly tightening, it seems like people continue to spend more money on their credit and debit cards. At least when you look at JPM's earnings, it's exactly what you see. People are spending more on discretionary goods despite the fact that we're supposed to be in a recession. And this is something that even Wells Fargo echoed, that people are spending more despite the idea of this recession. Now, on one hand, we make the argument that, okay, well, that'll be a limited candle. In other words, we'll have this candle of excess savings that we saved up, and once we burn through that, then we'll really have this mind-blowing, suffering recession. Maybe not, though. And this was the thesis we talked about yesterday. That is, maybe not. What if this recession is actually a recession of winners and losers? In other words, on one hand, you have wealthier individuals with exposure to stocks who were able to increase their allocation to some of their favorite stocks during the crisis. Maybe they were able to increase their exposure to certain businesses or opportunities that they were able to build during the crisis of the last year and a half. Maybe they were able to weed their businesses of talent that didn't end up being productive talent, and they were able to become leaner and actually boost up their margins and become a stronger company. And so therefore, on one hand, you have the winners. But then on the other hand, you have the losers, which might end up being office commercial real estate, which we think the time bomb of office real estate is going to destroy the entire real estate market. More on that in a moment, because it might not exactly be what we think, although technically it should be. We'll talk about it. But in addition to office, you might have people with lower incomes who, have seen their wages rise, but in real terms, which means inflation adjusted terms, we've actually seen their incomes go net negative. So you might work at Walmart, instead of making $14 now make $18, but thanks to inflation, you're actually not any further ahead, even though it feels like you're making more money. So the losers could really be those heavily affected by inflation, which are people who spend most of their money on expensive things, like, expensive necessities, food, gas, and rent. All three of those absolutely destroying lower income individuals. Whereas on the other hand, businesses are able to refine, wealthier individuals are spending through the recession, and if the stock market stages a recovery and most of real estate dodges the bullet of an office disaster, maybe this is not so much of a broad-based recession, but rather it's a recession for some and a victory lap for others. Consider the following, and this is something we yesterday were really thinking hard about, and this has to do with real estate because we continue to hear that, hey, office real estate is supposed to destroy the entire real estate market. And that's mostly because we continue to see defaults on office. In fact, just yesterday, we had more default announcements. Consider the following. Just yesterday, we ended up seeing a Los Angeles-based Brookfield asset manager default on two more, they originally defaulted on 2 office buildings in Los Angeles. Then they just defaulted on 12 offices that they hold in Washington, D.C. Just defaulted on $161 million of mortgages. Just, we're going to stop paying. We'll give the keys back to the bank. And a lot of people scratch their heads here and say, how is this possible? How are some people losing so much money in real estate? And how is this not going to affect the broader market? In fact, you're even seeing some of it extend over to multifamily. Consider this. You've got a Houston apartment owner, according to the Wall Street Journal, who's now facing foreclosure after losing 4 complexes with over 3,200 units. It's the Apple's Way Investment Group that borrowed $230 million that just got hit with a refinance. Can't refinance because rates are 2 to 3 times as high as they were. And what now? Now they're going into foreclosure. And so the question here is, wait a minute, isn't this a sign of what's to come? If the real estate market collapses, won't that pull everything else down? Well, let's think about that for a moment. So here's how this usually works. Ordinarily what happens is if you have a certain segment of the real estate market, let's say you have office here and multifamily. We'll do these separately for a moment here. And there goes the HDMI connection. Stand by for Kevin to fix the HDMI connection. Okay, I think I fixed it. Let's say you have office, and let's say office starts collapsing, and office actually does collapse. Let's go with that. Some office valuations are already down as much as 35%. So what happens when office prices go down? Let's go extreme, and let's say that prices go down 50%. Well, what happens when prices go down is you generally see a cap rate, which is basically your yield, go up. So when that yield goes up, it should become more attractive compared to other deals, usually because rents don't fall that fast. So in other words, you're in the situation where, okay, prices fell because that office space maybe was originally less desirable. But once the price falls to a certain point, the yield should go up. And even if rents have to be adjusted a bit, somebody else should be able to come in and buy them. And those people who usually come in to buy that office space tend to be substituting the other real estate they're buying. Maybe they were originally buying multifamily or retail or industrial, and they substitute those purchases for now heavily discounted office space because the yields are higher, right? Well, that's usually what happens, which usually drives the entire real estate market down because you've lost money at office and then you move money from other segments to office. But that's not actually necessarily what needs to happen, much like the broader economy. You could actually have, and look at this analogy here, you could actually have the winners and then you could have the losers. Just like you could have those who are highly affected by inflation on one side and those not affected by inflation on the other side. But wait a minute, how might that work? Well, the way this could actually work in real estate is you could potentially see office space be written down and become a lot less desirable because as those prices go down, maybe those rents are also equally driven down. Those cap rates don't actually become more desirable. And the best thing to do with a lot of 1960s, 50s, 70s office buildings that aren't desirable for condo conversions or aren't functional for new office spaces, those office spaces just go away. They get demolished. They get deleted. In other words, these become the losers. So people investing over here have invested in the losing side of this recession, and this really just disappears. leaving the multifamily and the other sectors, maybe even single family, really unscathed because of the disaster of office. So in other words, you have this tale of two cities of a recession potentially, where on one side you have office as a loser, and you have people highly affected by inflation, unfortunately, the losers in the economy. Whereas the winners are people, once again, with assets that in time tend to appreciate in value, people with more cash, businesses that are able to shave off excess workers and refine and increase their margins. And what you end up potentially happening is you end up getting no real recession. In other words, if you get a recession, it's potentially so delayed that it doesn't matter. Consider this. Estimates for a recession were originally that we were supposed to go into recession in Q3, Q4 of 2022. Those ended up getting pushed back to Q3 to Q4 of 2023. Now the market is saying, oh, we might not actually be in a recession until Q1 of 2024. Well, what happens if the recession, this looming recession, doesn't actually hit until Q4 2024? Well, let me ask you, if the recession doesn't technically hit until Q4 of 2024, are high margin businesses going to care? Are profitable real estate investments going to care? Are higher net worth individuals going to care? Unlikely. They likely won't care. In that case means there's also the potential that you have a tale of two cities in the stock market and the real estate market, where potentially on one side, let's say inflation is back at 2% when this recession hits, right? Well, if inflation is back at 2% when this delayed recession hits, Federal Reserve could turn on the money printer to try to help the poorer folks again, right? The Fed tries to help basically the losers. But what then happens is when you turn on the money printer, we already know what happens. It's actually not the poor people who win, because we know trickle-down economics doesn't work that well. You get maybe $100 that gets showered down, and $90 goes over to the winner side, and $10 goes over to the losing side. Why? Because again, when you turn the money printers on, who wins? It's people with assets. It's people who have stocks and real estate and businesses. Those are the people who regularly win. So the question that we discussed yesterday was, wait a minute, if this recession continues to get delayed, then what you actually have is the winners continuing to win in the meantime. As we ramp up for this recession, businesses have the luxury, dare I say, of cutting unproductive workers under the guise of a coming recession. Look at Ernst Young, just fired 5% of their staff, and they're in consulting, which makes you wonder, hey, wait a minute, these are a lot of layoffs, and tech is laying off to the tune of hundreds of thousands, it seems, for the last 6 to 8 months. Yet, when we actually look at employment reports, both ADP and the Bureau of Labor Statistics, technically we're actually gaining jobs on a monthly basis rather than losing jobs. So is it possible then that as the velocity of money starts actually and ironically and surprisingly increasing rather than decreasing, yeah, we might be seeing job loss, but is it possible that we're creating more productivity in this prep for a recession so we could barrel through the recession time? Look at the velocity of money right now. If you go to St. Louis Fred and you look at the velocity of money, usually what you would expect in a quantitative tightening cycle is that the velocity of money would be falling. And that's because people are tightening. People have less availability for lending. People are turning inward. They're spending less money. But if you actually look at the velocity of money, what you see happening is the velocity of money has started increasing as of the fourth quarter, which makes you wonder, did the velocity of money, with all this money printing that was done, really just fall substantially below this declining trend to where we could actually see ourselves through a recession as the velocity of money picks up again, leading to greater GDP, especially amongst those winners? Yeah, it's possible. Now look, The inverted yield curve technically hasn't been wrong in the past. The inverted yield curve says a recession is definitely going to happen, but it doesn't tell us when a recession is going to happen. And it certainly doesn't tell us when the stock market is going to bottom. In fact, if we go into history, the stock market usually bottoms before the end of a recession. And if you have a short recession, you can end up having a stock market bottom quite substantially early. In fact, take a look at this chart here. This shows that the S&P 500 actually bottomed as far as 9 months before the bottom of a recession in July to May of 1953 to 1954. And it shows you that, yeah, the average might be somewhere around 4 to 5 months, but there's no real consistency to say that this couldn't be 18 months or 2 years. It wouldn't be the average, but there's no consistency to say that it couldn't happen if we've once had the stock market bottom 10 months after a recession ended, back in 01 when we had the early dot-com recession, or after, or way before rather, like we had in 53 to 54. So the reality is, sure, might have a recession, but does that necessarily mean stocks have to bottom around that time? No. In fact, in many cases, like when you look at a company like Nike, we've already seen their earnings recession. And this is kind of weird to think about, that in many cases, recession could have already been behind us. Look at Nike, for example. Nike's earnings bottomed out with negative year-over-year net earnings for 2 quarters in a row, which means they were in an earnings recession last year when we were in the technical recession. Remember Q1 and Q2 when we had negative GDP? Maybe the technical recession already happened. Or maybe we'll have another minor recession ahead of us. But I'm convinced that we're living in a tale of two cities style reality. And so regardless of what ends up happening with recession yes or recession no, I don't personally think that matters much. What I think that really matters is making sure as individuals we can do everything that we can in our power to align with the side that's winning. And let's be really clear and provide that practical advice. The practical advice, non-personalized advice, obviously you know this, I'm a licensed financial advisor, I sell courses on building your wealth, I've got affiliate links, you can learn all about those, my ETF, the courses, everything at meetkevin.com, you know that already. But this can't be personalized financial advice because I don't know you. Maybe we could sit down and do an interview one day and then we could do some personalized advice. But the point is, if you want to be a winner in this market, maybe worrying about the recession is actually the wrong strategy. Maybe the strategy needs to be, what can you do to figure out what the losers are and what the winners are? And the losers are very clear. The losers are office real estate, and unfortunately, if your wages are under about the national average, $33 is the national average, and so I would take it maybe a little bit of a standard deviation further and say somewhere around $25. If your wages are under $25, you might have to think to yourself, okay, what can I do to get to a higher level? Maybe the company you're already in has you on a set path where you're going to be making a substantially higher salary in the future. But if you're at a potentially dead-end path, maybe the question is, what can you do to become a professional or create or increase rather your exposure to assets? Remember the 3 assets that matter here: bonds, real estate, I'll say bonds and stocks. So bonds and stocks, for most people that's going to be stocks, real estate, and then actually owning businesses. So we'll simplify that: stocks, real estate, businesses. Most people, especially when you're younger, under 40 years old, have the capability of generating some kind of professional license, whether that's a CPA, a lender, a realtor, whatever, has some form of professional designation, substantially increase your income by creating either your own business or working for somebody by making an above average wage, which would be above $33 an hour. Then use that to buy stocks and real estate. And maybe the Nike swoosh holds, the losers continue to be low earners who have negative real wage growth and office space. And maybe we end up with this tale of two cities of winners and losers style recession, where office is gonna look like it's in a recession. Poorer folks are gonna be like, damn, that time sucked. And wealthier people, or people with the assets, the stocks, the businesses, and real estate, are going to go, damn, that was a bitchin' buying opportunity. And what a great opportunity to increase margins at our business by laying off the unproductive workforce. It's the harsh reality. Nothing in this video is designed to be politically correct. Suggesting that people who are more affected by inflation are in the losing camp is a financial reality. It's certainly not the politically correct thing to say. But when we start considering that maybe we have this two-city style recession, maybe it means we've got to realign our expectations for this mega crash that's supposed to take down the whole world. Again, everybody's got fears about everything. There are fears about China invading Taiwan. There are fears about the de-dollarization. Rabobank just had a massive piece about the BRICS currency and the potential de-dollarization. And this is something that we've been talking about on the channel as well, this de-dollarization under potentially Joe Biden and potentially some of our weaknesses in the Middle East, Africa, and South America, leading to other countries wanting to flee the United States. We've talked about this many times before. And the reality is a lot of these fears could end up blowing into real problems, right? It is a problem if the dollar loses its reserve status. It's a problem if China invades Taiwan. But I think a lot of these are much more edge case scenarios, like the chance of us defaulting on our national debt, which would probably lead to a substantial decline in the stock market. But we've got to ask ourselves, do we want to be in a situation where we're constantly hedging for this impending recession or all of these potential edge case scenarios? Or do we want to do what we know is tried and true, which is exposing ourselves to stocks, businesses, and real estate, assets, so we could be part of the winning side? Now, of course, the biggest thing that destroys all of this and ends up destroying both sides, and this is the one red flag to both sides. There's one thing that could absolutely destroy both the losing side now and the winning side. There's one thing that destroys both of these sides. And folks, that is resurgent inflation. If for some reason the velocity of money increase that we're seeing ends up not just offsetting the quantitative tightening that we're seeing, or the tightening lending conditions that we're seeing, or the subprime autos market collapsing like we're seeing, if the velocity of money increase here does more than just offset those things, and it actually creates resurgent inflation, then we're screwed. Then the fact is both sides get hammered. Both sides end up getting Paul Volcker. You get people like Mr. Bullard who end up being right. Mr. Bullard actually just provided some commentary. Let's see what he says. Bullard still sees adequately restrictive policy rate at 5.5 to 5.75%, with a bias to hold longer until inflation goes away. Not much clear progress on inflation means interest rates need to continue to rise. He's referring to core inflation, unfortunately still remaining somewhat sticky at 5.6%. It's way too high. We need patience to get to 2%. And hopefully we can get inflation down. And if we get inflation down, which is my base case, that by the end of 2024 we end up getting inflation down, which requires patience, then the asset side will prove to be a winner again, as it historically always has. And the losing side will always be the side that ends up going bankrupt because of a regime change, or people who have low wages. Now, regime change in this case is probably just going to be the changing post-COVID dynamic, where people don't want to work out of 1960s, 70s, 80s, 50s offices anymore. And a lot of those buildings are just going to have to get demolished. Which sounds crazy because you might think it'd be realistic to turn them into condos. But the reality is, it's not. So, that gives you my opinion on the two-sided recession that we might be facing and how to potentially protect yourself. Obviously, if you want to learn exactly how to go from zero to millionaire in real estate, check out the programs linked down below. We've got a course on the stocks and psychology of money as well. The Elite Hustlers group for building your income, whether you're employed or self-employed, starting a business or otherwise. Check out those programs linked down below. But when it comes to recession, I'm really not terribly worried unless we see the ghost of inflation come back.